Welcome to the Three Corners Capital second quarter 2026 investment webinar. I'm Steve Fortin, and along with my partner Chris Flores, we are very pleased to host Evan Serton. Evan is a senior portfolio specialist with Cohen Steers, a leading global investment manager specializing in real assets like real estate and alternative income sources, and really focused on delivering attractive returns, income, and diversification. So, as we've said before in our work for clients, we utilize research and investment strategies from a variety of different players in the industry, different viewpoints, and Cohen Steers is one of the leading firms that we rely on in that endeavor. So we greatly appreciate their partnership and willingness to share insights today with our clients and friends. So with that, let's dive in. Evan, when most people think of investment real estate, they may imagine office buildings or apartment complexes, maybe some retail stores. But real estate is much more than that and has changed quite a lot over the past 2 to 3 decades or so. So how would you frame the current market, the current publicly traded real estate market, and the benefits for investors?
Sure. Steve, it's a pleasure to be here and talk about all of this. As you said, it's what we do. It's what we've been doing for literally decades now, and maybe it's just worth starting at the most basic level, which is to say that commercial real estate is the world's third largest asset class. So by that fact alone, it merits consideration in an overall investment portfolio. It's the third largest. It's only behind stocks and bonds in the investment landscape. And you can see some of the data we've compiled here. Now, what we're doing in our portfolios is exclusively in the publicly traded market. So yes, while US commercial real estate all told totals over $20 trillion. That's a very large number, of course. The publicly traded component of that commercial real estate market is but a small subset of that. But it's generally of the highest quality across that $20 trillion landscape that is represented by the publicly traded real estate market. And of course, the commercial real estate market inherently has a different trajectory of performance, a different sort of market cycle than conventional stocks and bonds. And that's even greater reason to consider it in an overall asset allocation. Now, when we talk about the publicly traded commercial real estate market, it is true that there are a lot of myths to dispel, especially around the makeup of that market. And so what we've seen over the last several decades is that newer property types not only have emerged in the publicly traded real estate markets, but they've begun to dominate the publicly traded market. So what you see on the slide here, that right-hand table, is in fact a breakdown of the property types that comprise today's publicly traded real estate market. You can see all of the percentages here. And it does surprise a lot of people to realize that some of the largest parts of the commercial real estate market, the publicly traded commercial real estate market, are in property types that may not immediately come to mind. So when you contemplate senior housing, and to think that senior housing is one of the largest discrete property types in the publicly traded real estate market, it does reorient the mind, I think, a little bit. Mm-hmm. And then you compare that, of course, to something like office. You look at this table here and you realize that office is only 2% of today's publicly traded real estate market. And of course, office has faced a lot of headwinds over the last half decade. We suspect it will continue to face a lot of headwinds. And so the investment opportunities are materially different. You've got property types like cell towers and data centers, obviously very technology-oriented property types that are also meaningful parts of this market. And so what I'd say is that demographics in the form of things like senior housing and technology in the form of cell towers and data centers, these are property types, these are parts of the market that are going to have longer tailwinds than a lot of people realize. And so the opportunities are rich for that reason.
Yeah, yeah, fascinating. And we've been proponents of the real estate asset class for many years, for the income or return opportunities. And one thing that's really been top of mind for a lot of investors lately is just valuations and the fact that, the past several years we've seen large growth technology stocks really dominate and outperform. And that's led to, some concerns. Are we in a new bubble or that kind of thing? A lot of market concentration, in the top 7 or 8 stocks, the Magnificent Seven or the Elite Eight, whatever you want to call them. How would you describe, REIT valuations historically and how they are today?
Yeah, I'd say, just a little bit of history here. So we're at a point now where we've seen 4 consecutive calendar years. So when you start from 2022 all the way to 2025, in each of those 4 calendar years, the listed real estate market has underperformed the S&P 500. The last year that REITs outperformed the S&P 500 was in 2021, which was a big snapback year following
Mhm.
the end of the pandemic. And so what we've lived through these last 4 years or so is a reaction to rising interest rates, of course, but it's not just a story of rising rates. It's also a story of declining REIT cash flow growth over that time. And that
Mhm.
declining REIT cash flow growth, I would attribute to a lot of new supply of commercial real estate making its way into the market, sectors like apartments and industrial, which is really the warehouse and logistics market. There's been a lot of new supply added, and that's weighed on rental growth and ultimately on cash flow growth. So you've had these kinds of conditions that have helped REITs underperform. And of course, as you said, broad market equities, large cap technology stocks have done very well over that same period. So what we're at now, and you can see it here on the screen, that left-hand chart, what that left-hand chart shows you is the relative valuation of publicly traded real estate companies versus the S&P 500. So, and this chart goes over the last 20 years or so of relative value. And plainly, there have been times in the last 2 decades when REITs are more richly valued versus stocks on an earnings multiple basis. But plainly, that's not the case right now. So if you look all the way to the right of this chart, that's where we were at the end of 2025. So at the end of 2025, after 4 years of underperforming the S&P 500, REITs were at one of their cheapest valuations versus broad market equities in the last 2 decades. You really have to go to the early part of COVID to see
Mhm.
anything comparable. And of course, we did see a big snapback in 2021 that helped to reverse that. But the point remains that when REITs get as cheap as they are right now versus broad market equities, good things tend to happen in terms of forward performance. And we've already started to see that in the early part of 2026. REITs have outperformed stocks so far this year.
Yeah, we've definitely noted that. And, a lot of the concern, obviously, with geopolitical stress, energy and inflation concerns, with what's going on in the Middle East.
Yeah.
And that's led to volatility in the bond market and higher yields. How do you see, I mean, I know, you're not a geopolitical expert, but how do you see that affecting risk and return for real estate, potential outcomes as we look out the next year or so?
Yeah, I'd say that the good news as it relates to REITs is that the very large majority of their own earnings come from domestic sources.
Hmm.
So not that they're not vulnerable in any way to geopolitics or to concerns about energy or inflation. There's certainly a component of that, but the earnings tend to be much more domestic, and they tend to be a lot less volatile. And so we would expect REITs in a period of heightened geopolitical uncertainty or even macro uncertainty to be something of a beneficiary, at least on a relative basis. What you see on the screen right now happens to be part of what makes us quite favorable on the asset class from this point. Not only are our valuations cheap, but I described before how over the last several years, cash flow growth has been declining, and you can see really from that peak that we saw in 2021 all the way through 2025, it's been a mostly downward and certainly below trend environment for REIT cash flows. And that has contributed to some of the performance challenges we've seen in this asset class. Now, plainly, what you see, and these are our own estimates, Cohen and Steers' estimates for the next several years, plainly, we are anticipating a reacceleration of REIT cash flow growth this year and over the next several years. What that reacceleration reflects is a supply and demand environment that has grown a lot more attractive from a landlord's perspective. I mentioned before, too, how there's been a lot of new supply introduced into the market in sectors like apartments, in sectors like industrial, and that's contributed to some of that cash flow weakness that you see on the chart. Most of that supply has by now been absorbed. Construction starts for new development, construction starts have fallen a lot, and inflationary pressures over the last few years have contributed to that. The cost of land, the cost of labor, the cost of materials has all increased a lot. So it's a lot more challenging for property developers to bring new assets to market today than it was several years ago. And so what we are entering right now is a multi-year period of meaningfully low new supply. And you add to that tight supply environment a demand environment in the form of things like technology-related real estate, the data centers, the cell towers, demographically driven real estate, the aging of the population, what that means for senior housing demand. It's part of why healthcare happens to be the largest sector in our market today. There are meaningful secular drivers of demand for major parts of our universe of companies. And so you combine that tight supply environment that we're entering with that secular growth in demand, and that helps to explain our expectations for accelerating REIT cash flow growth over the next several years. That's an environment in which REITs tend to do significantly well. Like I said, the last 4 years has been a story of rising rates and falling growth. That kind of stagflationary set of conditions generally isn't good for REITs, but we are entering an environment that is much more hospitable for performance.
Yeah, interesting. So, yeah, we've heard a lot about data center construction and, the pros and cons and concerns about that. Aside from the sectors that you've talked about, medical, senior housing and so forth, medical space, industrial and data centers, what other sectors are positioned well and which are not, and what could cause, some turnarounds for different sectors?
Yeah, when you look at our current portfolio, and this is our portfolio at year end, so you can see very plainly how the portfolio is allocated by property type. Again, everything that we're doing in this portfolio is an investment in publicly traded companies. So all of these sectors um, relate to securities of companies that own and operate assets in these sectors. So one of the sectors we've grown more interested in over the last year or so, in fact, happens to be office. You can see how minimally office is represented in our overall universe. But when you look at this table, you'll see a modest overweight to office REITs. This is the first time, really, in the last 7 or so years that we've been overweight office REITs. We went into the pandemic already underweight office REITs. As you can imagine, that was a good call. Because office REITs faced back then, at the beginning of the pandemic, a lot of headwinds, and they still do to some extent. What we are seeing now, though, is a reacceleration of demand and of leasing activity in coastal markets. So think San Francisco, think New York. Yes, we've seen pretty significant return to office trends in those areas, but there's also an argument that some of this AI enthusiasm, some of this AI development is actually taking place on the West Coast in markets like San Francisco. And AI developers themselves are starting to seek out greater office space to build out their own businesses. And so we're starting to see, off of course, a very low base, that reacceleration of demand, of leasing activity. We believe that will be very additive to earnings and ultimately to the share prices of these companies. So that's something we're paying attention to. I'd say when you look at property types where we're a bit more cautious, it is in sectors like apartments and industrial, the two sectors that I mentioned before that have seen a lot of new supply come online over the last several years. That's weighed on rental growth, as I explained, and cash flow growth. And there are still pockets of supply in those sectors that have yet to be fully absorbed. And so we do anticipate a return to favorable rental growth. It's just going to take a longer time. And so we're more cautious on those property types as a result.
Yeah, yeah. It's really, again, back to the data center. I see that, cell towers and data centers are two big overweights compared to the index. Is data centers kind of similar to, the build out that the industrial space had for several years, where it just seemed like, Amazon and others were just going to keep building more and more warehouses. We kind of just, where would you kind of characterize? Are we in the early innings, middle innings, or late innings on the whole data center construction thing? I know that's a tough question.
Well, I would say we're still early. And
Hmm.
part of the reason I say that is because obviously when you're a data center business, you're not renting out square footage to a tenant in the way that a conventional landlord would rent out square footage. You're renting out power. And as AI continues to proliferate and demands from AI continue to proliferate, you're necessarily going to need more power to fuel those kinds of services. And so what we are seeing now is that power availability is at quite a premium, and it's happening to curtail the amount of new supply of data centers that are making their way into the market. Yes, there is, of course, ongoing development of data center assets, but it will be meaningfully curtailed by the ability of these developers to access the power necessary to fuel these modern technologies. And so what we're seeing as a result of that is that the asset owners that already have the power availability can continue to charge higher and higher rents. That's exactly what the REITs that we own in that sector are doing, which is why we like them as much as we do.
Hmm. Wow, great stuff. Well, thank you very much, Evan. This has been fantastic, super interesting, and very helpful. We appreciate you sharing your knowledge and insights. And thank you to all of our clients and guests for watching today. If you have any questions whatsoever about today's discussion or would like to discuss your personal planning and how this affects that, please feel free to reach out anytime. Thanks again and have a great day.